Okay, the next thing we need to discuss on along these lines of Quant or Quack is this. I'm going to prove to you that what you've been told is not true. And I'm going to show you that the things that appear to be one way are quite another. Okay? Now, if the computer algorithm is so amazing and so powerful, then we have to do business with this. We got to deal with this. And I'm going to do it. I'm going to belabor the point until you get it. Alright? Okay. I told you that the smart money that everyone keeps talking about is really dumb money. Okay? It's ignorant. Alright? So, let's dive into it. Everyone wants to say, how can you prove that? I'm about to prove it. Do you remember a company called LTCM, Long-Term Capital Management? Does that ring a bell? Well, you see, Long-Term Capital Management was a U.S. hedge fund which used trading strategies such as what we're talking about, combining it with high leverage to trade, okay? It failed miserably back in the late 90s. And it led to a massive bailout. That's a term we're all familiar with, okay? And we were like this close to bringing down the entire financial infrastructure as we know it, thanks to long-term capital management. Now, I want you to feast on this. I want you to hear me when I break this down for you, okay? For those of you who are unfamiliar with this. But as I break this down, just remember this. A algorithm is only as good as the person that programmed it. Just because you're a mathematical quant, alright, does not make you a trader, okay? I don't care how many programs you can write, how many computer software systems you can have running at the same time. I don't care if you have a room with 500 computers and 500 CPUs and 10,000 monitors and 100 students from MIT. If you can't trade, you don't understand the markets, you're not going to make any money. The only way they make money is by cheating, and we'll deal with that a little bit later. But when I say cheating, I don't mean cheating like you think I mean cheating. I mean taking advantage of loopholes in the laws so that they can make profit, and then when those loopholes are closed, they have to close up shop. Like in 2008, remember when all the money was being liquidated from our economy, and the markets were crashing all over as people were pulling out of the market? Do you know how many hedge funds closed up shop in 07 and 08 and 09? Hedge funds were closing their doors in droves. Do you know why they were closing their doors? Self-admittedly, because they said they could no longer make money in the market. They said, we can't make money in this market. Not because the market was crazy, because up until that point, the market was moving straight up. So it wasn't crazy. It wasn't even volatile. It was just moving straight up. Straight up line. Look at the chart. Look at the chart. From 05 to 07, straight up. Straight up. So what changed in September of 08 to make people run for the hills and say, I can't make money in this market anymore? It wasn't because the fundamentals of the stock exchanges changed. It wasn't because rules changed, so to speak, but they knew that some rules down the pipe were coming that were going to close these loopholes and make it impossible for them to cheat the public like they were doing, and thus making profits like Bernie Madoff for their clients. Bernie Madoff. Interesting that how he came out right after all this stuff went down, right? Where was everyone when he was cheating everyone with $50 billion or plus? What was that? What was going on with that? See, when those windows of opportunity got shut, it brought out the Bernies, and Bernie is one of many. I could name some more people for you, and you would hit the floor, your jaw would hit the floor. You say, no, that person is so respected. How can you say that? Like I said in the other video, I know a lot of these people personally. Alright? You have no idea what I've done and where I've been. But you should be asking yourself this question. If I can predict the markets with the level of accuracy that I've been doing and extract money from these markets the way I've been doing and teaching you and showing you how to do it all for free, who am I? And what have I done, and where have I been, and what else do I know? That's what you should probably be asking yourself. Get it? All right, back to LTCM. Who were these people? I'm proving to you right now that the Quant, more likely than not, is a quack. Not all quants are quacks. Some quants are actually traders, all right, who quantitatively program their approaches, all right. A lot of them start off like me. I started off being a discretionary trader, and I took all of the strategies that I learned in my experience and just went ahead and just parlayed that into computer code. That's pretty much all that is. All right, first of all, here are the partners of long-term capital management, and some of these names you are familiar with and some of them you're not, but I'm going to run them down for you, and then you tell me, is the Quant a quack? John Merriweather, former vice chair and head of bond trading at Salomon Brothers. He has an MBA from the University of Chicago. For those of you who don't know, the University of Chicago can be harder to get into than Harvard. So that means he was an egghead, all right? Geek. Robert C. Merton, leading scholar in finance, PhD, Massachusetts Institute of Technology. That means MIT, you guys, boys and girls, MIT. All right? And professor at Harvard University. Harvard. How about Myron Scholes, co-author of the Black-Scholes model? You know, that options program model that shows you how to price option volatility and whatnot? PhD, University of Chicago, professor at Stanford University. David W. Mullins Jr., Vice Chairman of the Federal Reserve, PhD, MIT, professor at Harvard University, was seen as a potential successor to Alan Greenspan at one point. Eric Rosenfeld, an arbitrage group at Salomon, PhD, MIT, former Harvard Business School professor. William Krasker, arbitrage group at Salomon, PhD, MIT, former Harvard Business School professor. Gregory Hawkins, arbitrage group at Salomon, PhD, MIT, worked on Bill Clinton's campaign for Arkansas State Attorney General. Larry Hillenbrand, arbitrage group at Salomon, PhD, MIT. James McKenty, bond trader. Dick Leahy, executive at Salomon. Victor Hagani, arbitrage group at Salomon's Masters in Finance, LSE. Look at all these credentials, man. And it goes on even beyond that. It goes on beyond that. You really have to dig deep and see what's up with this stuff, man. I'm telling you. I mean, these guys were the creme of the creme, okay? These guys were top notch, okay? They could walk into a room and demand billions just off of their name, okay? These guys were all of that. John Merriweather headed the Salomon Brothers bond trading desk until he was forced to resign in 1991 when his top bond trader, Paul Moser, admitted to falsifying bids on the U.S. Treasury auctions, man. Cheating. Because Salomon was the largest bidder on the Treasury bonds at auction, the Treasury Department feared that Salomon would be able to take a strategic position on the bonds in order to influence the price. That's not trading, that's cheating. See what I mean by cheating? As such, Salomon or any single bidder was restricted from purchasing more than 35% of the bonds sold at any auction. Moser circumvented this limitation by making fraudulent bids on behalf of Salomon clients and then transferring the bonds to Salomon's accounts following the transaction. The revelation of this scandal depressed the company's share price and drove investor Warren Buffett to sack its chief executive officer, John Gutfreund. Though Merriweather was not directly implicated, calls for his ousting rose within the company, and he resigned before he was let go. So you need to understand what we're dealing with here, okay? We're dealing with individuals who were only out to milk the unsuspecting of their money. They were the original Bernie Madoffs, okay? You need to understand that. They cheated. They avoided taxes, okay? They tried to hide losses. They did a whole bunch of stuff. But the purpose of this video is not to break all that down. The purpose of this video is to show you that these were considered the best and the brightest minds on the planet at that time. And they still blew up. They blew up. You know, kaboom. Okay, and need a bailout. So that should tell you something as far as the markets are concerned. So